What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. We've got some serious brain power joining us this week. Benson Durham is head of global policy and asset allocation at Piper Sandler and an adjunct professor at Columbia University in NYU. His previous experience spans central banking, Wall Street, and academia. He was on the official staff of the Federal Reserve Board, as well as the Federal Reserve Bank of New York, and a senior advisor at the IMF. He has also held positions as a quantitative analyst and portfolio manager at firms such as TIAA-CREF, Capital Group, Brevin Howard, and BlackRock, and was an adjunct professor of economics at Georgetown University. His research on financial asset pricing, monetary policy, macroeconomic growth, and political economy has appeared in journals such as the Journal of Portfolio Management, Financial Analysts Journal, European Economic Review, Journal of Financial and Quantitative Analysis, and International Organization. He earned his BA and PhD in political science from the University of California at Berkeley and Columbia University, respectively, and his MSc in mathematical finance from Oxford University. All right, Benson, Steve and I are psyched to have you on at this important time in markets. There's so much going on. We could talk about the beautiful budding relationship between Chairman Powell and President Trump, or we can dive into this week's soft payroll report and what that means for interest rates and Powell's reaction function. Would love to hear your current thoughts on what we're going to be hearing over the next several weeks from Fed speakers and what you think the Fed's going to do in September.
We had 2 dissents at the last meeting, right? So that's a big, some people a big deal. Now, there've been 2 dissents before, but they usually don't happen from the board itself in DC. But we got 2. It hadn't happened since the age of Greenspan in 1993. Waller and Bowman dropped a couple pages of explanations for, kind of why they dissented. And Waller kind of gave us a hint that he was going to do this, right? So he gave a speech on July 17th along the lines of basically why I want to cut rates at this meeting. And he pretty much regurgitated that, right? So they must be feeling pretty smug this morning because their argument was based, kind of entirely on softness in the labor market, particularly, kind of private sector payrolls. And indeed, we got pretty big revisions down, not just a weak number this morning, which is about a standard error surprise. I think it came in 174. The expectation was around 100, but it was the revisions from the month before as well, which kind of piled on there, right? So their argument is kind of in some ways panning out, right? And so, it's kind of natural. I think the market responds to a certain degree. Things are maybe tilting in that direction. And the Fed is fixing the cut. And the SEP, the dot plot says, the median, right? So it's a group of people. The middle value among them expected back in June to cut twice. We only have 3 more meetings left. So when are you going to do it? And so it seems, so it's not unreasonable to, kind of expect it. The news just keeps coming, doesn't it? Right. So not only did we get the data this morning, but we woke up with the, a little bit harsher news on tariffs, right? Which kind of roiled the market. And so the Fed has this complicated thing going on, right, with tariffs, because, they hit the outlook, not so good for the outlook, but, there is this inflation question. So I would wake up this morning, you get a soft number, which usually in terms of the employment would make you want to ease. But it doesn't get any easier. So it's sort of sorting it out, right? So I think where is the market now? Like, maybe close to 80% then on a cut
for September,
which to me seems about right, because we're going to get more data between then.
So is this employment report for Powell a game changer that's going to impact his tone? Because I think he's been fairly consistent and transparent on his reaction function, trying to describe that to markets and journalists that are asking him questions. And he's continued to point to the labor market as something that, if it softened, would get them to more likely cut. So is this enough, assuming that we don't get any other standard deviations in the data in the next several weeks?
Yeah, I don't know. I'm kind of a stickler on grammar. And, to me, data are plural. And there's a word called datum, which is the singular of data. So I think what Powell would say was this is a datum. This is one data point. And moreover, he was asked at the presser about something along the lines of job growth. Like, what is the equilibrium job growth that you're looking for on Friday? Probably a little bit less than what we got, but he said something this. He said, well, the number you want to look at is the unemployment rate. So you have the establishment survey on the one hand, which gave us the payroll number, and then you have the household survey, which gives us unemployment. So those are 2 different surveys. And so I think he would probably take the signal that there are signs. He told us he was worried about the labor market, as you said. There are reasons to worry about it, but they did pencil in 4.5 for unemployment by the end of this year. After this morning, we're still at 4.2. So there's a little bit more deterioration to go as they give us those two cuts. So I think it was a big number. Obviously, anytime you get a couple standard error surprise, a 250 downward revision to the numbers, that's a big deal. I think there's more data to come. So you need to also see the inflation side. So I think he takes it in, I wouldn't say in stride, but I wouldn't say it's like this big structural break in his thinking.
It's to your point that the revisions, I would say, would make it plural until we get the revisions next month.
Okay.
We'll see.
Yeah, no, that's right.
And then we got the JOLTS data this week, which came in softer. But yeah, well, the market certainly continues to be very reactive to the data. And yeah, like you said, who knows? It'll get interesting, I think, in the next coming weeks, if we do indeed see the CPI numbers tick up again, adding some more volatility. But I'm going to be really interested in hearing how Powell, if that happens, his tone sounds, if he puts more weight on employment. The market puts a lot of weight, though it's only one data point, on NFP. It's the most forecasted number on Bloomberg. It probably gets the highest ratings on CNBC when that report comes out. And for all of Wall Street that is very fundamentally focused, it's probably the one data set they certainly pay attention to.
Yeah, and the other thing we have coming up is the Jackson Hole thing, otherwise known as J-Hole.
Yes.
You're in the know.
Yes.
I think it's like one of the more overrated events. It is on the calendar. There've been a couple doozies over the year for sure. I mean, there's kind of the announcement of QE2. Bernanke kind of gave us one. And then last year, the chair gave the time has come for policy to adjust speech, kind of right before they started cutting rates. And then they gave us 50. So that will be an opportunity, Michael, for him to say something, about things that kind of mark stuff to market. But I don't know, I did a little bit of analysis comparing just market moves on J-Hole days compared to just data release days and surprises like this morning. And there's really nothing to write home about. It's not really, there's no pressure. There's no promise of giving us any kind of news whatsoever. But it will be when all eyes and ears will be on him. It looks like the last time he'll do it. We get one inflation number before then. I think the speech would be on the 22nd or 23rd, that Friday. So that he'll kind of comment and give us, kind of a little bit more clues about what he's thinking. But I shouldn't say that. It's not really him. I mean, we should really remember that it's a committee. It's not like Jay Powell. What does he decide to do with the interest rate? There are multiple interest rates for one. And then the other is there is very much a committee.
You mentioned inflation there. So far, we've talked a little about the employment picture because of the number today. What's your thoughts on how the Fed is viewing the price picture?
If it weren't for tariffs, they'd be cutting already. Would have probably done it back in June. So I think that probably, would have gotten to a phase where they would be confident enough that we're getting down to 2%. And I think they need to get to 2%. And so now it's really they used to use this phrase, placeholder assumptions. So how in the world is this going to shake out? And I think it's been a little bit stalled. It's not really clear that it's showing up in the way that we might have expected it to show up now necessarily. But there are other people who think it's in train. And also we keep getting new news. People talk about the one-time increase in the price level. Well, I don't know. It seems like we get them almost on a daily basis and not necessarily tied to things in economics. Tied to, I don't like your policy on Palestine, or, I don't like what the judges are doing down in South America. So here's a big tariff for you. It's a lot. It's tricky for the Fed to be. And the chair said this. The chair said at the press conference that these are early days, kind of a long way to go. So I think in the inflation view, it's been maybe a little bit longer, Stephen, for them to get a sense of what the impact would be, in part because the policies are in some ways evolving. I think the key, though, one thing that, I say this all the time, and it just seems worthwhile to say all the time, is that it's really long-run inflation expectations, which is precondition for everything. So you cannot see through. Even if the effects were transitory and you wanted to see through, you wouldn't be able to see through unless long-run inflation expectations were where they should be, where they want them to be. And so I think the Fed's view, what's the Fed's view on inflation? I think they're pretty confident about that part, that people think that they're actually going to get down to the target eventually. So the different measures of this, you can use surveys. You can also look at markets. You can look at the difference between nominal forward rates and forward tips yields. That would give you a rough sense of it, but you need a model kind of tease out tips and liquidity premium. That's something that, kind of people like me like to do some research on. And those look great. So and kind of surprisingly good, frankly. So I think they're kind of a little bit delayed on like the near-term inflation outlook. There's still a lot of uncertainty. But I do think they do take some comfort that in the end, people think it's going to be okay.
Yeah. Would you agree? So we got the soft payroll number, but also today we got a whole long list of new tariffs. August 1st. And so does that reset the clock? And does this mean that we're still going to be data dependent and there's really not much more visibility? We have new data, but really visibility hasn't really changed all that much.
Yeah, well, I think it's data dependence and also capricious policy dependence. How do you respond to trade policies which turn on a dime? Yeah, it's not like you get this one-time shock. Like, okay, these are the tariffs. I mean, and then it's complicated enough. Yeah, so it is data dependent. So it's like, so you're waiting on the shock. You're waiting on the news on how the shock transmits into the data and asset prices. Yeah, so I think again, so we can't be myopic about SEP. They feel like they go in September, but then are we going to know everything by then? We're going to be in this situation for a while. At least, don't mean to bring this up, but at least this committee, this Federal Reserve, this chair, this board of governors, and this set of regional Fed presidents. I don't like bringing this up, but it does loom. So the transition to the new chair looms over all of this and how that shakes out. What matters is what the Fed signals about what they're going to do. So it's increasingly hard for them to credibly signal what they're going to do. Yeah. Players involved are going to change. The nature of things is going to change. It's going to be all this, Michael. It's going to be all this, a little bit more of the parlor game intrigue, but it just increasingly as the year winds down.
So what's the typical transition play out when you have a new Fed chairperson? Does it usually announced after a meeting so there's not too much of a lame duck chairperson?
It's longer than that. So it wouldn't be like, oh, the next meeting, here's a new person. Usually the time, I think it's varied a little bit. I think Biden was a little late, but usually it's a few meetings, couple meetings, 3 meetings. I have to look at the historical record. In general, it's been a little bit more lead time. So it's not, even if it keeps changing. The Treasury Secretary once said, the fall, then he recently said by the end of this year.
Yeah.
That's about within the historical norms of when we would get a sense. The bigger issue is the notion of what would the change be? Greenspan to Bernanke was just different. Okay, well, here's this academic. Bernanke to Yellen was like, okay, here's another academic.
Yeah.
And then Yellen to Jay Powell was a little bit, okay, this is going to be a little bit different. We're kind of breaking this recent mold of econ PhDs, was someone who was on the board and everybody was comfortable with all these people. So Bernanke taught a lot of my old colleagues at the Fed. So Bernanke was a governor. A professor at Princeton. Janet Yellen was president of the San Francisco Fed. Again, advisor to a lot of my colleagues. And Jay Powell was different. But again, look, there's a little bit of a theater around who this person's going to be and what their attitude is going to be. And their attitude towards preserving central bank autonomy and the rest of it, which looms pretty large for the back end of the curve, if I'm being honest. It's not something I don't relish bringing it up. Be talking to people who are more, I don't want to say initiated, but people who are not, don't need to know about the Fed on a day-to-day basis. Like if you're an equity portfolio manager, you just need to know of what to look out for.
Yeah.
But what is more important to what to look out for than this issue? If you're not trading the front end of the curve or you're not at a bond PM.
I was going to bring it up. I was going to ask about it.
I just wanted to bring it up on my own terms. I knew it was coming.
I'd love to hear about the long end of the curve and what you're thinking there too.
So one thing, I really want to know recently about this. So I think from as much as discussion has been and notions about not just the Fed chair, about tariffs and other things, this notion about this sell America trade is afoot.
Yeah.
I'm kind of convinced everywhere I look, although I think rates are probably a little bit too high, frankly. But at the same time, it's hard for me to think that's going on at the back end when it arguably could be, or at least you hear some voices which make you think that they should be. For the people who don't really traffic in rates very much, in some meetings I have, I like to open up with a question, well, whose rates are higher this year, like around the world, right? And everyone would think, oh, it must be the U.S. because the U.S. is a basket case. It's trading like an emerging market, et cetera, et cetera. The correct answer is, well, JGBs are leading the way up, then followed by boons, and then U.S. Treasuries, which are actually 10-year point are actually down on the year. And then we can look at this a little more sophisticated way, like if you look at term premiums, which is stripping out this expected policy path and asking the question, well, okay, how much compensation do I demand to loan to these governments? That really hasn't changed for treasuries at all. And then option prices too, you would think, even if those are the base case, like, oh, in the end, it's going to be fine for the back end of the curve. I'm going to pay a lot for big losses on treasuries in the event that it's Chair Maria Bartiromo and the Fed is completely run by a perceived lackey or toady, that this could be the case. Turns out that's not what I get in the tails of the options distribution. It's general plain vanilla econometric forecasts do fine. explaining where those option prices are. So yeah, I'm a little bit ambivalent about the back end. I like bonds, and we can get to that in general compared to what you guys cover. Yeah, no, there's my thoughts about it. And it is kind of funny to be the back end is, I think, potentially influenced by political economy as much as the real economy.
The term premium is something that's been coming up about a year now. And correct me if I'm wrong, I believe the term premium roughly bottomed around COVID and it's been grinding higher back into positive territory fairly steadily. It's not like it just shot up into positive territory when Trump was elected or even around April 2nd. When you look at the term premium and look for evidence of the sell America trade, do you see it? Or like, to me, if like that was a real story, wouldn't we have some kind of outlier reading or even something close to it if that was really the case?
So that's where you would look, and you would look at not just, so there are, well, term premiums are estimates, and there are term premiums all over the curve.
Yeah.
So there's even term premiums at the front end of the curve, but people are uncertain about monetary policy. Anyway, so you would want to look at the back end of the curve. So when all the Fed changes are done, what are you charging the Treasury to loan them money? Yeah, so that's exactly right. And you're also right that most estimates have been creeping up from really low levels, like almost close to historical levels if the history is the last 35 years or something like that. But I think if you're really supposed to see this, so nobody really worried about the Christine Lagarde being able to do her job, or Bailey in the UK, or, Ueda in Japan being able to not have to face this torrent of tweets and be fired and all this other kind of stuff. So I think the appropriate place to see it, Michael, is not necessarily in the level of the term premium, although you would see that in the US. It would be the spread between term premium estimates between the US, Boons, JGBs, and Gilts. So I do these estimates for those countries as well, and those spreads just haven't really moved. Interesting enough, US term premium do tend to be higher than those jurisdictions, which is a whole other 45-minute conversation. But they haven't been increased at all, really, over this period. So it's as if like the debt brake in Germany has driven those term premiums higher. And then obviously in Japan, they're kind of been unwinding kind of quite an experiment in that case, which loosely speaking, generally would be associated with higher term premiums. So it's not, I can't really find a lot of angst in the back end of the Treasury curve.
Yeah. And only for a few weeks around Liberation Day did we see the back end of the curve rise or steepen, 30-year yields going up and a weaker dollar. But that seemed to have been, dare I say, transitory, because I'd say probably the last 2 months, we've generally seen the dollar and interest rates begin to move together. Like we're looking at today, the dollar's off 1%. Yields have rallied massively off a softer employment report. September rate cut odds are up to 80%. So all of that, I think, makes sense. That's not the sell America trade or the end of exceptionalism. So I struggle, I think it's a great media soundbite, but I really struggle to find any evidence.
Well, I think there's some people, we live in charged times, and I think there's some people who wish it true. So, you can imagine, this is the case of former Treasury secretaries from the other side. It's very compelling for them to kind of point to this. See, look, this is all mismanagement, and this is what you get. It's a similar issue with deficits. I think deficits matter for yields, but when I look at the data, it's not really so clear. People have a normative view on deficits. Governments shouldn't run deficits, and so look, they're making rates higher, and you see, isn't that bad? And I think it's funny how these biases cloud our empirical assessment of what's going on in the world. So I kind of agree with you. It's not like I'm saying, or I think you're saying, it's not like we're saying that there isn't this risk, and that we love everything. It's more like, well, we ain't seen nothing yet. If you're really worried about this, and, we do get something which is more pernicious and something that folk are worried about. So there's juice in that trade. If you're sitting around, kind of waiting for the U.S. to trade like an emerging market, things can get a whole hell of a lot worse.
Yeah. And even to add one more data point that people focused on certainly earlier in the year was the underperformance of U.S. equities to the rest of the world. And, that was certainly true roughly up until March 18th, where that was the point where you literally had European equities, for example, going up while U.S. equities were going down, which is not often something you see. But I'm looking right now at a chart in local currency of U.S. equities relative to European equities, and they're at a 6-month high. And, I think people overlook the fact that from a U.S. dollar perspective or U.S. investor perspective, most of the gains you've had in buying those European ETFs have really just been about the stronger euro, not really about better European local equity performance. So I want to touch on that as well, because you do a lot of work on asset allocation, looking at valuations, and especially with your central bank hat on, how does this all extend to global markets in terms of where rates are going in the US and how you think global equities valuations look today?
Yeah. I mean, it's hard not to think about the dollar bears, like whether you're hedged or not, is bared more than it usually does on the actual outcomes. So I think kind of to net that out, I tend to look at it in hedge terms in some sense. But yeah, I mean, I think one of the things about equity fraud, which I know you guys have, well, or not, that you have obviously have views on, is it is also not really a stateside thing at all. So when I think about, trying to think of, you can think of any asset as the discounted value of expected cash flows. And so you think about, what are earnings expectations around the world, and how would you discount those back to today, given, term premium estimates in these different jurisdictions, as well as other things that might be soaking up the kind of the local equity risk premium. And the U.S. has never really stood out as kind of being all that particularly frothy. And so when I look at the metrics that I maintain, and these are kind of slower moving beasts, these are not valuations tend to not correct overnight. So this has kind of been the case for a while, where the U.S. has not been necessarily on the sell side. If you were to say, okay, well, want to go short all the worst markets and have an offsetting positions in the ones that don't look so bad, it's not like the U.S. has been. It's more like some parts of Europe, frankly, which has been a little bit surprising. At least it was surprising back, especially with the Ukraine war, as well as the outlook. And now you kind of get a similar picture. But for me, you got to kind of pick your battles and where are the cleavages, what are the decisions you have to make in terms of asset allocation. I love to hear what you guys think about this, but for me, it's kind of more, well, if you're right about the stock bond mix, that's kind of matters more than picking between the US versus Europe or the Kospi, right, which is up like crazy this year. I think for me, that's the most important thing that I would kind of underscore. For me, it is what's the prettiest horse in the glue factory, what's the cleanest dirty shirt kind of world that we live in. And as you mentioned, term premiums have adjusted, they've moved up. And what that means, it's just fancy word for saying required returns on bonds are higher now. We all have our favorite measures of the equity risk premium are pretty dadgum low, right? And so it's not hard to come up with a chart which says something to the effect of, well, look, you really don't get paid much more to own equities than you do bonds. And so none of them, necessarily look great. They're risks, they're horror stories we could tell about the bond market as we've been hashing out. But I don't know, that's kind of where I come down is the most important thing, even globally. So around the world, I would say this is the case. But what's interesting though, as well, is I would have said that if you asked me if we were doing this in January, I would have said the same thing. And you would have thought that, maybe that trade is like, maybe that's a widowmaker trade because the stock market is kind of hung in there on net, obviously.
Yep, sure.
New highs. But I don't think that's so. If you look at global investment grade bond indices or even treasuries, remember they've rallied on net over the year. And I think, as you mentioned as well, on net, we've had a few harrowing days. There's been a negative correlation between a bond market and equity market returns. And equity market volatility has exceeded bond market volatility no matter what you read in the newspaper. Sure. So on a risk-adjusted basis, so if you're like have a 60-40 bogey and you care about the amount of return per unit of risk, I'll make these calculations soon. I feel a note coming on, right? So being precise about it. I think on a risk-adjusted basis, you would have done much better, maybe 50-50 as otherwise. So it's not been a widowmaker. So I think that the hedging value of bonds has hung in there. And so, but I think I would still say the same in terms of asset allocation. Look, I mean, all these horror stories about the Fed, and maybe you have some views on this. So let's say it's the worst Fed outcome. Bad for bonds. Really, really bad for bonds. How is it great for the equity premium? Sure. Isn't there, especially if you buy into relative valuations, that there's some, kind of a lot more risk at stake maybe. But anyway, you put a quarter in me. And I was, mainly referencing what's happening, what my views on the US, but I think that it's pretty similar. If I look at valuations for the DAX versus where boons maybe should be trading, and looks like boons are pretty roughed up relative to fundamentals, relative to what people think the ECB is going to do, measures the term premium, et cetera. Whereas, I don't know, people don't seem to discount cash flows by much in those areas.
So Benson, we had Jay Gubina on a few weeks ago, and who is one of the economists at Piper Sandler. And one of the discussions that we had was talking about the quality of data and modeling macro data. And you, of course, have to model macro data and also reaction functions of both markets and policymakers. So how is in the last several years where data quality's come into question, response behavior, reactivity behavior has been sometimes shorter, sometimes longer. And of course, the prevalence of using AI and other technologies to help your work. How have you used that? And do you ever see the Fed using any of these new technology tools?
Yeah, no, I did have a conversation with some, yeah, I don't know if I should drop names, but someone pretty senior about that. And I'll just leave it at that. But the subject matter was, well, maybe you can have AI write the minute of the Fed meeting. Sure. It's something which I used to do as a staffer. You'd have to draft it, right? And imagine maybe feeding it and it being more useful for them to kind of kickstart it. Now it's not, obviously, when you use ChatGPT or something else, you just have somebody to spit something out to you. You edit it. You say, no, that's not right. You give it to them back and they spit it back out. So I think there's definitely probably a bit of that the Fed is thinking about. I think in terms of the data and its quality is probably harder. Yeah. So I think the challenges are harder for a real side economist like Jake. I think asset prices, I think that those data are getting better, arguably, right? So it's going to be a bit frustrating, right? As exchanges stay open 24 hours, like what is a day's trade? I have to rethink all my programs to figure out where to take the marking. So I think on that side of it has not been a challenge, at least for me. I think you said AI, but I also think, there's just been there are a lot of things that we knew, the royal that we knew how to do decades ago, but just didn't have the machines to do them. So people thought about multi-layer neural networks many years ago, but didn't, there's some figuring out how to estimate them, but there was also like, we have these punch cards. There's no way we could possibly do it. And now we're all, I think, kind of punching above our weight a little bit. So you try I'm talking more about econometrics, right? And methodologies in some sense. I don't know if that's where you kind of, what you had in mind about it, but, we're all kind of have these machines, which, have the computational oomph to be able to do things that we couldn't do, even 10 years ago. And so I think for me, though, actually, this is relevant to the reaction functions and trying to analyze them, because when computers were simpler, I guess, and, econometrics was simpler, we get by with running, examining linear relationships, right? Yeah. You have, 1 unit move in X corresponds with, a movement in Y, right? But, the world is, is much more complicated than that. And, it depends on where that, that variable is. There could be breakpoints. There could be, a host of nonlinear relationships. And so a lot of these methods in AI in particular, most of like deep learning and neural networks are really good at kind of estimating these nonlinear things, right? They're very facile with them, kind of remarkably so. And it's just up to us to kind of let go because we're kind of used to thinking in linear terms and kind of letting the data speak. It sounds hokey, but, in some sense, it's an acknowledgement that the world is kind of complicated and there are certain feedbacks and certain interactions between different things, which, a lot of these models now can handle pretty well. So I, for example, have kind of gravitated from running, although I still do, I like to run models of things, but not just one model. So, sometimes I will say, I ran 10.1 million models because I don't know what the right one is, but they're all linear. Now I am coming much more comfortable with using a neural network for these things, right? Because I don't know, I may not know how the bond market, the stock market, it's kind of requires some hubris to say, the bond market and the stock market is going to respond in a linear way to these things, right? And for me to kind of say, well, I know these factors matter. You can't put crap in a model, right? You have to be thoughtful about what you put into any model. Sure. But I think, it's becoming increasingly accepted. And I think it's okay to be flexible about your thinking about what the interaction is between, the macroeconomic variables that we analyze all the time and how they relate to financial asset prices. I think is something that we, kind of definitely embrace. I've kind of gone off a little bit more on the eggheady research side of things, but as opposed to like, will any of us have jobs? Yeah.
Like the market, we'll worry about that when that day comes. Well, so how do you think about, you talked about inputs and, obviously one of the biggest inputs in markets is human beings. While there may be more machines and smarter machines in the markets these days, many decisions are still being made by a human brain. And I would argue that when you think of the consensus, the human brain does think in a linear way and keep it simple, stupid. So how do you balance a model and especially a nonlinear model and the output of that in a market that can have a big influence from investors. And I don't mean this in a negative way. I just think, we tend to think in a binary way and a linear way, and increasingly in recent years when there's uncertainty, in a very short-term myopic way. So how do you think about that when speaking with clients?
I think that's a good point. I mean, so what the irony is that the kind of motivation for neural networks, and if you go back to something, one of the forerunners of that was something called the perceptron, and it was billed as is meant to actually work like a human. And the neuron, actually, a neural network is officially an artificial neural network because there are neural networks in our brains, right? So ironically, these methodologies are meant to kind of operate the way the brain processes information. Now, you bring up an interesting point about markets and how they do, they got the number this morning and then, it's by the 2 years. So and it could seem very linear. I think I guess the way I would explain it is these models are trying to capture where prices eventually sort of settle, not necessarily saying this is where the market's going to react with every tick, because that's driven by her behavior and all kinds of stuff. It's kind of more because again, it matters what you put into the model. So when you put in a model like this, it's stuff like expected earnings, expected inflation, expected GDP growth, budget deficit, stuff like that, not things that are easy to measure over a long period of time. So I guess it's, of course, the issue is in the long run, we're all dead. You have to stay solvent as long as you have a position based on one of these things. But that's, of course, the rub. And there's as much, so in the background, I guess, as I sometimes say to clients, it's always kind of like, well, this is the model that you have, which gives you the, rich or cheap signal, right?
Mm-hmm.
There's a big effort into that. An equal effort that takes up just as much, if not more, my time is, how long does it take those errors to correct, to get back to being fair, which is a whole other set of challenges and what, we all kind of need to work on, because at the end of the day, we need to be right at least some of the time. And these things need to work.
I know Michael wanted to ask, when you're not running millions of models or teaching or doing all of these things that you do, which I don't know how you find the time, what do you do for fun?
I work on stuff which I have a hard time keeping running. So I have this E65 two-stroke Saab, which I have to add the oil in when I go to the gas station. It's not a fuel injection or anything like that. And it's just like I cannot, I think this day job is hard. I don't know if this is fun or not. One of my hobbies is probably more challenging. Financial markets, keeping that old car running. But I like some old technologies like that. Gives me a nice hedge against all the other stuff that we've been talking about. And my daughter's a nice source of fun for me. Although I will be an empty nester soon, starting next month. My youngest is going off to college, so this what I do in my spare time is coming to the fore of my personal life pretty soon, because I'll have a little bit more free time to think about that. So
that's got to be bittersweet. My oldest is got one more year of high school left, so I'll pick your brain to see what you're doing to fill your time. I'm sure it'll be interesting, and there's always plenty of work out there. Quick question: I want to circle back. You meant two-stroke engine. Is that the same thing as a two-cycle? Like when I think of my leaf blower or like a small engine. So when you literally have to add oil to mix with the gas.
Yeah, but I mean, I do it like I do my coffee, right? So I put my cream in before I pour it. That's exactly how I do it at the gas station.
Wow.
But I have to do all the measurements, right? Because that's how the engine gets its lubrication, though, is by pouring it. So you're constantly either on the gas fully or you're off the gas. But it basically is like a lawnmower. And it is so loud. I got pulled over by the cops once, not for speeding or reckless driving. He just pulled me over and said, "This is just too loud."
How many pistons are in it?
It's a three-cylinder, and I think uses like 55 horsepower or something like that, but it's a very angry beast.
Wow, I'm sure it sounds like it meets those EPA standards.
There's a little bit of blue smoke in the back, but it's offset by how infrequently it actually runs. So
well, you must have two, one in the shop, one to take you to the shop.
Well, that's the argument. That would be my argument to my wife to get another one, but she's probably definitely not having it. But it's an adventure, right? Because every time you get in the car, you have to plan on not being able to come back, right? You have to say, okay, or every time you stop the car, you have to be prepared. Okay, this, may not get this going again. I've had everything happen to it. I've had the exhaust manifold fall out of me. One time it's a column shift, and one time I was shifting gears and the whole shifter came out. So it's an adventure. All this stuff we're talking about is actually easier than dealing with transport from the 1960s. So
that's super interesting. I'd love to see a photo of that one day, and even a video of you driving it.
Well, this is awesome, Benson. Thank you so much for doing this. It was a great conversation, and we hope to have you on again soon.
Anytime. No, thanks for having me. Pleasure's been mine.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.